We've reduced the slabs. There shall be only 2 slabs. And we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing, and refunds. These reforms have been carried out with a focus on the common man.
India cuts taxes on hundreds of consumer goods, from soaps and cars to insurance, to boost spending and soften the blow from Trump's punishing tariffs. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Indian consumption stocks will be in focus when markets open in about 45 minutes. But globally, investors are watching for clues on the Fed's next move. Templeton Global Investment CIO Manraj Sekhon will be joining us with his take on the biggest market drivers for the rest of the year. We'll also speak with Moody's ratings on how India's consumption tax cut could impact government finances. And later in the show, we're joined by Rishika, Chandan, managing partner at Venturi Partners, a VC firm specializing in high-growth consumer brands in India. Here's a look across the Asia trading session. Chinese markets taking a bit of a hit. Take a look at where we are in terms of the CSI 300 index, down almost 2% after a Bloomberg scoop on China's regulators weighing cooling measures for stocks after a $1.2 trillion rally from the start of August. The CSI 300 down more than 2% for its biggest slide, by the way, since April. We're also keeping an eye on long-dated bonds, including a 30-year government bond auction in Japan coming up later this hour. Global ultra-long bonds are under pressure from fiscal as well as inflation worries. Also watching Indian stock futures as we count down to the India Open later this hour. India is cutting consumption taxes across the country to boost local demand and support the economy in the face of President Trump's 50% tariffs. The cuts will come into effect September 22nd and will affect most everyday items along with insurance premiums as well as vehicles. Officials, however, will raise taxes on sin goods such as cigarettes, chewing tobacco, and some luxury cars. We spoke earlier with Morgan Stanley's Chief Asia and EM equity strategist Jonathan Gardner on opportunities he sees in India. Have a listen.
So it's very likely that earnings will swing up on a cyclical basis from here, and valuations have come down quite a bit. It's still an expensive market, but deservedly so given the trend earnings growth, but it has derated by essentially about 5 forward PE points from the top, which was a year ago. So it is quite an interesting market to look at here.
Let's get more on the market implications of India's consumption tax cut. Bloomberg senior Asia equities reporter Abhishek Vishnoi joins us now. Abhishek, I mean, this must be market positive.
Oh, absolutely. And, it's more positive for the market than the economy. But you have to keep in mind the context that Prime Minister Narendra Modi actually spoke about it during his Independence Day speech. So since then, a bunch of stocks have already discounted this optimism, which I'd say are staples. So consumer staples as a theme has discounted this to a great extent. But consumer discretionary spending related stocks are yet to price this in. And, the impact is not just because the taxes have been cut and rationalized. It has also been cut ahead of festive season, and it has been cut in a manner where, the market share is largely going to move from unorganized players to the organized ones, and most of the organized ones, or at least a whole host of them, are listed in the stock market. So it's definitely way more positive for market. And as Jonathan was saying, that this might actually, sow the seeds of an earnings upgrade cycle, or at least least the bottoming of earnings, that we have been seeing in India. I was talking to a bunch of strategists, before, coming on air, and what I got was that definitely, it sort of adds to the monetary as well as fiscal measures that government has been carrying out over the past few quarters, and put together, this might actually be enough to put a floor in earnings and maybe even start a new upgrade cycle for India equities.
But on the fiscal concerns, if you take a look at the bond market, we saw how yields surged on the back of that, because there are concerns perhaps India will have to issue more bonds to support spending.
That's right. I mean, it would be a concern on the fiscal side, but it's nothing that one should worry about. I mean, our reporting and, my talks with a variety of market participants sort of suggest that, this is pretty much manageable. It's not something which will put the credit rating or profiles in danger. And this was the need of the hour. I mean, it was either these kind of measures that support the market or support the economy, or, you're taking tariffs with a pinch of salt, and that can impact the market's psyche even more. Remember, like the context that we have been pointing out, that India has been among the major markets which have underperformed this year, and significantly. Money has been rotating out. Global investors have been exiting the market on fears of valuations and earnings not picking up as expected, slowing down capex over the last 2 years. So, in this backdrop, it was way more important to take care of these things before actually thinking about fiscal profile, and it is manageable even if you talk to bond investors, if you talk to market participants.
Abhishek, thank you so much for that. Bloomberg senior Asia equities reporter Abhishek Vishnoi. Let's get insights on what this means for long-term investment opportunities in India. Manraj Sekhon is CIO of Templeton Global Investments. Manraj, good to have you with us. I mean, we heard from Sitharaman, the finance minister. She says it is very positive for GDP, but how much can you counter that 50% tariffs from the U.S.?
Well, I think you have to consider a few things. First of all, how long will this 50% tariff be in place for? Is it here for the short term? Is it here for the medium term or beyond? Once we see the Russia-Ukraine situation resolved, which we're probably closer to the end than the beginning, then I think the pressure on India with respect to what President Trump feels about oil imports from Russia, that pressure eases. So I think you have to ask yourself about whether the tariffs are here for a very long time or not. In terms of the tax cuts, I think it's very positive. If you look at something fairly simple, just like price elasticity of demand in India compared to, say, the US or China, it's much higher in India given the profile of the average consumer, lower income, and so on. The last time taxes were adjusted back in 2019, you did see a meaningful improvement in demand, especially for consumer discretionary items. So I would argue there will be an improvement, there will be a significant improvement. And on the point on the fiscal situation, if you look back in 2019 again when they did it last, net, it was positive for the fiscal position because the increase in demand more than offset the reduction in taxes. So I think all of that is positive. And when you look at the inflation picture in India, it has been fairly well behaved. You have a new chairman of the Reserve Bank who is fairly dovish. He's been easing monetary policy. So when you put that together, an easing monetary policy picture, decent inflation numbers, tax cuts, a market where sentiment is pretty poor, expectations are low given what's happened with tariffs, I think this is a positive catalyst for the market for the medium term.
Positive, but does it fundamentally change the view of the Indian market? Does it make it so much more attractive that foreign investors are going to be flocking in?
I think you have to split the short term and the long term. I think in the short term, some people who don't fully appreciate what's going on in India are focused on the on the tariff increases. But if you look at the long-term dynamics of India, the secular growth, the demographics, the talent, none of those stories have changed. And I think when you look at the performance of the Indian market over the long term, these corrections in time have proven to be buying opportunities. So I would argue those fundamental secular drivers haven't changed. In the short term, you might still see some some noise thanks to tariffs, thanks to the uncertainty brought about by tariff policy out of Washington. But in the medium to longer term, we're still very constructive on India.
So buy India and buy consumption plays. After all, consumption is 60% of GDP.
Well, I think consumption will be a short-term beneficiary from the policy changes, but if you look broadly across the market, the number of other sectors that have been beaten up because of the tariff situation, and I think you have to be very stock-specific. The thing about the tariff situation is that companies that have pricing power, companies that are in a very secure part of supply chains, of value chains, those are the ones that will benefit. And I think you have to be very stock specific in India. Consumer is an area, there's some other areas as well.
What is the biggest risk right now for India? I mean, we talk about that 50% tariffs, and you question how long that would be, and the signs are not really positive right now.
Yeah, well, I think we need to focus on what the agenda is out of Washington. Now, the most important thing on the agenda for President Trump is the trade deal with China. He's focused on that. The Chinese are focused on that. They don't want anything to get in the way of that because of how important that economic relationship is. Once he gets that out of the way, I believe the next one will be Russia-Ukraine. That issue needs to be resolved. We're closer to the end than the beginning. The Europeans haven't come to the table yet. They need to. Once that pressure comes off, and it will have to come off before 2026 meaningfully begins, because at that point President Trump will be focused on the midterm elections, which are very, very important for him, especially now. I think then the focus comes on what else he can do. So once that pressure is off with respect to Russia, I think you could see some avenues where India and US find a way of coming back to the table. Right now that looks a long way away, but bear in mind the approach out of DC has been fairly transactional, based on the issue of the day in the eyes of the Trump administration. So I think we shouldn't rule that out.
The other issue that investors are focusing on in India is actually Jane Street. Now it says it's pushing back on the manipulation violation which SEBI has imposed on it. How are you, as an investor, looking at that situation? What are the implications broadly?
Sure. I think regulatory situations in any jurisdiction are tricky, and I'm not privy to the specifics of Jane Street and SEBI, but I'm sure they will work it out over time. But I think SEBI has always been focused on what ensures a long-term, liquid, efficient market, and what works for all segments of Indian society in terms of investors in the market. So I think they'll be very focused on that. The only thing I would say is I don't think this will be resolved in a very short period of time.
But this is a high-stakes legal battle in a way, right?
Yes.
And it could set the precedent for the future for foreign investors in India.
It's difficult to speculate, but I think wherever you look in the world, there have been regulatory situations which have looked very tricky at a particular point in time, but over time they all get resolved.
And for the broader market, it is about the Fed, how much it will cut, what it will do, and what's crucial actually is that data coming out on Friday. If the data comes in weak, might 50 be a possibility? Might 50 be on the cards in September?
Who knows? 25 or 50, I think. It doesn't really make a huge amount of difference. I think in the short term...
it's the optics, isn't it?
Well,
if he does a 50.
Perhaps, but non-farm payrolls are a very volatile data series. We're coming at the end of the summer in the US, which has been a very active summer. The weather's played a big part in things, so it's very difficult to predict what the short-term numbers are going to be. Having said that, I do believe that over the next 6 to 9 months, Chairman Powell will be thinking about the legacy he leaves behind for his term at the Fed. There will be likely a dovish new Fed chairman that will come in. Currently, markets are expecting something in the region of 150 basis points
by the end of next year.
Between now and the end of next year. I would argue that's excessive. I think if you look at interest rate forecasts over the last few years, they have been pretty inaccurate in terms of predicting a easing monetary policy cycle, and I think the same will happen this time. I think we're going to see easing. I would be very surprised if we see 150 basis points by this time next year. If you look at what's happening around the world, the impact of tariffs, if you look at the comments from Secretary Bessent on how much the U.S. is pulling in from tariffs, it's annualizing at about $330 billion. That's a big number. If you look at, say, personal consumption expenditure in the U.S., just the change year on year is about $1.5 trillion last year, ballpark. So 333 billion is a big number. That number has to come from somewhere. So the two things I think we should be looking out for are inflation numbers, perhaps spiking, reflecting those tariffs, and that could be cause for concern for the market short term, and also just the overall demand picture. We've seen evidence that demand has been pulled forward earlier in the year, given tariffs. So companies, consumers have been pulling forward demand so that they don't have to pay up for tariffs. So it is logical that you will see some follow-up from that in terms of slowdown. So I think those are a couple of things to look out for, which could spook markets in the short term.
Neutral, 3%. How quickly might we get there?
I think it'll take longer than people expect currently.
How much longer?
I don't think we get there before the end of next year, as the markets are expecting.
So given that the markets are pricing in deeper rate cuts than what you're suggesting, is there too much optimism in the stock market right now? I mean, take a look at where we are. We're constantly testing new highs.
Well, again, there's the headline and there's what's happening underneath. Now, if you look at the headline, the markets are up significantly. If you look at the performance of markets since Liberation Day, 5 stocks account for 3/4 of the S&P 500. The S&P 500 is looking at double-digit returns year to date, but the median stock is probably low single digit. So there's a real bifurcation in the market between the AI winners in this AI arms race, because the marginal returns from AI investment are still supernormal right now, and the market's giving those companies a lot of credit for the investment they're making. And then there's the rest of the market where there's uncertainty, where the tariffs are having an impact, where there is evidence of a slowdown. If you look at some of the logistics companies, they are talking about a slowdown. If you talk to the advertising companies, the traditional advertising companies, there is evidence of a slowdown. So you do have this bifurcated economy, bifurcated market. Headlines suggest a very healthy S&P 500, but that again, in 2025, as it was last year, is concentrated in a small number of companies. So I think there's scope for disappointment in that space.
So what? We could see a correction of what, 10%, 20%? Some have suggested that could be the case.
I think a 10% correction is not unreasonable to expect, given how strong this market has been and the amount of profits there are out there to take. But I would say that any correction will probably be short-lived, because you have got such a large segment of the market that has lagged, and their valuations are not as demanding as the very large companies. So there is not a lot of optimism there. There's very low expectation. There's enough scope for rotation into those companies.
To your point, the concentration risks are there. How do you play? How best? And what are some of the major changes you make to your portfolio that you're willing to share?
Well, we take a long-term view. I think the AI story is undeniably one of the biggest stories in our lifetime, and that's going to change the way all businesses operate. It's happening already. So I think you have to be in that story. Now, where you position yourself is important, and I think the semiconductor companies, including those in Asia, are real beneficiaries of that. Some of the hyperscalers are executing extremely well. So I think you have to be very careful, but you have to be positioned within that. Now, outside of that area, I think you also have to look at some of the places that have lagged. Some of the areas that have lagged, say in the US, have been areas like healthcare, some of the consumer discretionary areas. So valuations have begun to look a lot more attractive there, and we're looking at some of those areas to take away some of the steam away from the bigger stocks in the market.
Manraj, Manraj, China, it has been a red-hot market, and today we hear that the Chinese government is possibly looking at, speculative investments. Your take on where the market's headed?
Yeah, I would come back to the big picture again. The most important focus for Beijing right now, as it is for Washington, I would argue, is this trade deal between China and the U.S. And the Chinese leadership does not want to see anything distract or get away from that. So any signal to the U.S. that the Chinese market is looking through that risk, is interpreting the outcome overly positively, I think is something they would like to avoid. And when you come back to President Xi Jinping's agenda, and has been the case since he's stepped up into his role, common prosperity hasn't gone away. Common prosperity is about alignment. It's about ensuring that different parts of the Chinese population benefit from growth, benefit from the opportunities in the same way. Domestic demand hasn't really picked up in China this year, despite some of the improvements, some of the reforms.
And property sector hasn't either.
It hasn't. So again, that rally has been driven by very cheap valuations, some expectation that we're past the bottom in China, which is probably fair, but they want to take the steam out of the market. So I think it's something we have to watch closely.
But the AI plays in China are attractive, no?
Well, I think China's one of the biggest beneficiaries from AI, and they have some of the most interesting companies and interesting technologies. Not enough attention is being paid there by global investors right now, and I think that will continue to be interesting for years to come. So it is an area we like a lot.
Manraj, always a pleasure to have you with us. Manraj Sekhon, CIO of Templeton Global Investments. Still ahead this hour, Moody's Ratings Senior Vice President for Credit Strategy, Nicky will be joining us for analysis of India's debt markets and economic outlook ahead of the new tax cuts. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Indian Prime Minister Narendra Modi is hailing the GST Council's decision to lower the nationwide consumption tax. The tax cuts are expected to put more disposable income in the hands of consumers to lift consumption, which accounts for 60% of India's GDP. For more on the latest reforms, let's bring in our South Asia economy editor, Ruchi Bhatia in New Delhi. Ruchi, we have to pay attention to the timing of this announcement.
Oh, absolutely. In fact, this is coming in right ahead of the main festive season in India, that is Diwali, that happens to be in the month of October. And remember, a lot of consumers had deferred their purchases in the run-up to the big festival, and hoping that the GST cuts far and wide will really reduce the prices of a lot of goods. And that's exactly what has happened. From the existing 4 slabs, we now have only 2 rate slabs, which is the 5% tax category and the 18% tax category, and more than 400 products ranging from toothpaste to TV. The GST rates have been reduced on that. Also remember, this consumption tax cut is coming in at a time when India's economy is expected to get a big hit from the punitive 50% tariffs that have been imposed by US President Donald Trump. If you look at the last GDP figures, we did see a good growth, but the expectation is that going forward we may see some sort of a tapering of growth in the economy, tapering of expansion in the economy, and this is what the consumption tax is aimed toward. The expectation is that there will be more buoyancy. Now we will see more people getting into the markets, buying products. This is going to spur consumption that accounts for almost 60% of India's GDP. Having said that, it is going to come at a cost of 480 billion rupees for the exchequer. So that is something that one has to look at as to how the government is going to fill this big hole, and also how the states will be compensated, because the states have said that there is some sort of a revenue loss that they will be facing as well. But for now, in the interest of consumption, they have given it a go-ahead. But needs to be seen how the compensation cess or for various states will be worked out by the federal government.
What are some of the options? What might the government do to ensure that its coffers are still filled?
So, as far as the federal government is concerned, we already know that there's a big bonanza that came in earlier this year from India's central bank that is going to sufficiently, keep the kitty intact, the government's kitty intact. On top of it, there is an expectation that there will be a privatization for IDBI Bank that will happen this year, which will also give some substantial chunk of money to the government. So all in all, so far, the federal government is saying that they will be able to stick to their 4.4% fiscal deficit target for this year. But remember, the borrowing program for the second half of the fiscal year kickstarts from the 1st of October. We will be hearing from the government on their proposed plans very soon. But there was a risk that various market participants saw in terms of whether there will be any fiscal slippage, because it's not just the GST cuts. Remember, the government is also talking about some sort of incentives that may come in for exporters, and what will that mean for the central exchequer is something that we will have to wait and watch out for.
Ruchi, thank you so much for that perspective. South Asia economy editor Ruchi Bhatia there in New Delhi. Well, India's tax cuts have a net impact of around $5.5 billion on the government's revenues, which the country's revenue secretary is fiscally sustainable. Let's get perspective from Nicky Dang, Senior Vice President, Credit Strategy and Research Group at Moody's Ratings. And Nicky, your thoughts on the fiscal position of India on the back of those consumption tax cuts?
Yeah, thank you. And I think this is similar to the other guest has said. So basically, we're looking at a 480 billion rupee worth of tax cut or revenue loss at this point, which is equivalent to about 0.14% of the GDP. So that's a relatively small amount. So we're expecting the government to be on track of maintaining a 4.4% of GDP fiscal deficits this year. But don't forget, I think there was also putting in the budget, the whole thing was really trying to stimulate or boost more private consumption, which is going to strengthen the growth for the economy on the backdrop of a 50% tariff coming from the U.S. side. And this is a continuation of government's supportive measures in addition to the income tax cut that's been implemented and put into the fiscal budget for the budget for the fiscal year 2025 to 2026. But in our estimate, given that India is still a large domestic-driven economy, the 50% tariff is going to take a toll of the GDP by 0.3%. So that's a lower estimate, and we're still getting to a 7% full calendar year growth estimate for this year.
But, Nicky, there's still some concerns out there. We continue to talk about, the bond market, how yields surge, because there are concerns that perhaps the government will have to issue more debt to support its spending plans. I mean, is that something you're looking at?
Yes, indeed. We're looking at a more balanced view of how the government is going to fund this $480 billion. But again, I think on the relative size perspective, right, relative to what the government is putting on the table, I don't think that's going to have a big dent to the government's continued fiscal consolidation at this point.
So just to be clear, the tax cuts, are they sustainable or not?
Well, at this point, it's a small portion, and what we're hoping to see is more of a growth coming from the tax cut, especially for the private consumption, which, as you noted, 60% of India's GDP but in the recent years, I don't think the household is suffering from a lot of high inflation and reduced disposable income for the household, and so that's what the government is trying to resolve at this point at again the 480 billion rupees of cost.
Nicky, just hang tight. We have several headlines to tell our viewers about. Japan's 30-year bond bid cover ratio is 3.31 versus the 12-month average of 3.38. Once again, of course, this is an auction which we have been keeping an eye on, the 30-year bond bid cover ratio of 3.31 versus 12-month average of 3.38. We've been talking about how this 30-year seems to be a pretty much unloved duration. The auction tail has been a wide range of 0.02% to 0.75%. And in terms of yields, they've climbed from 2.3% to 3.3%. Again, Japan's 30-year bond auction, which we have been keeping an eye on, that bid cover ratio is 3.31. The monthly average was for a 12-month period, 3.38. Nicky, just coming back to our conversation, in terms of credit ratings, we've seen some concerns, especially when it comes to the developments in Indonesia, those violent protests we've seen. Are you reassessing Indonesia's credit rating on the back of that?
Well, of course, we're monitoring and working very closely with where the domestic uncertainty, the protest is taking us. But at this point, I think it's really on the protest came on the backdrop of a lot of concerns on softening of the economic growth and job prospect, as well as the income disparity in that sense. And we're still expecting a 4.7% GDP growth this year and next for Indonesia. But if the unrest is sustained, a heightened political uncertainty is sustained in that sense, we're going to see some downside risk to that, in particular as reflected in the FDI, inflow FDI, which Indonesia heavily relies on. I think the recent first half of the GDP growth is fairly decent in a way. However, the growth pattern is a little bit concerning and raising some of the concerns among the public. That is, the growth driver mainly comes from the good production output from agriculture sectors as well as the downstream processing sectors. However, the growth in those sectors were not able to offset the job losses in the more labor-intensive sectors such as textiles and garments and some part of the auto industries. That's causing wide concerns about disparity in growth, and that has implication on the weakening of living standards.
In terms of its fiscal deficit, do you see a risk that it could breach the 3%, target?
We'll have to see how things evolve, in particular for this year, given also we also have headwinds from the tariff impact, right? So, but we're assessing the situation as it goes.
What in particular are you looking out for before deciding whether or not that could be a downgrade in its credit rating? This is a situation which has been brewing for months.
Yeah, and I wouldn't be speaking on behalf of the expert. I'm not a sovereign analyst in any means. But again, our holistic approach is looking at many aspects of the fundamentals of the credit strength of issuer, sovereign issuer. That includes economic strengths, physical strengths, as well as external risk of vulnerabilities. So a whole slew of things have to come together in order for us to take a rating action.
I guess when it comes to Asia-Pacific in particular, those tariffs from the U.S. have a bearing on how the economies will fare for the rest of the year and the coming years. How are you weighing those tariffs and how the economies will fare?
Yeah, I mean, overall, we rate about 25 sovereign issuers in the region, and we're looking at a collective, the GDP-weighted growth rate of 4.1% this year. This is slightly down from what we had last year in the region. So in relative terms, the tariffs are higher, tariffs are real, but relatively speaking, the region's economy is relatively resilient to this tariff shock, if you will. We're also looking at for 2026. However, the growth is going to slow down for the region, and same for the global economy as well, given the tariff uncertainty will keep percolating into different aspects of the economy, including the business decisions, business investments, and consumer sentiments.
How about in terms of China's credit rating? Some say that perhaps its credit conditions are pretty much resilient, pretty stable at this point in time. Is that a fair assessment?
When we're talking about credit condition, we're talking about a lot of credit supplies and demands in the economy. As we all know, China is facing external challenges because of uncertainties of the trade negotiations with the U.S. And domestically, we're also looking at an economy that remains to be export-driven, at least for the first half of this year, due to a lot of front-loading. However, monetary policies and supportive measures from fiscal support is also helping the household in terms of the expanding consumptions on some of the household items, including EVs, electronics, as part of trade-in scheme, subsidy scheme. However, looking under the hood, so to speak, there has been no broad-based recovery of private consumptions. We are still looking at a very muted retail sales growth for the first half, and which also came down to 3.7% in July. The investment sentiment still remains very low. The private investments remains in a contraction area, and this is mainly because of muted consumer sentiments due to the income growth, weakened income growth and growth prospect, as well as job prospect, tag along with the continued drag from the property sector in that sense. So again, the momentum that's happening in the first half, we're expecting to by the pull ahead from export sector is going to wane in the second half of the year. We're expecting to see a full year growth of 4.7% this year, but next year it's going to come down to further down to 4% in absence of additional government supports.
And Nicky, thank you so much for that. Nicky Dang, Senior Vice President, Credit Strategy and Research Group at Moody's Ratings. Still to come, we'll focus in on India's sales tax cuts, implications for regular consumers with Venturi partners Rishika, Chandan. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's been trading for about a minute now from the get-go. Take a look at that. It's green pretty much across the board. The Sensex up by 0.7%, adding to the 0.5% gain just yesterday. And not surprising that Indian staples, auto stocks, they're rallying after the consumption tax cuts announced just yesterday. Take a look at where we are in terms of the Nifty 100, also higher by 0.8%. Now, the revamp of India's consumption tax marks the first major change since its implementation in 2017. Reforms have long been sought by Indian businesses, which have often struggled with a convoluted, multi-tiered GST regime since its introduction. For a look at just how convoluted it is, here's the popular popcorn explanation as an example. Under the old rate structure, spiced or salted popcorn sold loose was taxed at 5%, but if the exact same product was sold pre-packaged and labeled, it was taxed at 12%. If you had a sweet tooth and opted for the caramel version, which I would, the tax rate would jump to 18%. Thankfully, things are expected to get a bit easier now. While we're still waiting for the fine print, the new GST regime is set to tax salted or spicy popcorn at 5%, regardless of whether it's sold loose or packaged. Sadly, the rate will still be 18% for those with a sweet tooth, as caramel popcorn falls under the sugary treats category. Bad news for me. Venturi Partners is a Singapore-based private equity firm investing in consumer brands across India and Southeast Asia. The firm raised $150 million in the first close of its second funding round, with a final target of $225 million by mid-2026. Let's get insights, perspective from Rishika, Chandan, Managing Partner at Venturi Partners. Good to have you with us.
Thank you so much. It's a pleasure being here.
First off, your reaction to the consumption tax cut.
Yeah, well, I think, it's good for our portfolio companies. We have a portfolio company that operates in the dairy space, so it's definitely a net positive that. We have one we're investing in the nuts and dry fruit space. I think all around it's definitely good for boosting consumption. Taking a step back, I think, this is India's strategic sort of step in trying to balance domestic economic consumption together with external shocks. And while we're yet to see the second order effects of this in terms of how fiscal deficit gets impacted, and I think to that extent India is playing the thin line of trying to balance both. They do have the ability to use a little bit of fiscal flexibility to be able to boost domestic consumption. So I think this hopefully should be a net positive, but the second order impact is yet to be assessed completely.
Net positive, is it necessarily the same for urban and rural consumers?
No, I think, I think it would largely, at least looking at where the cuts have come from, likely to boost more rural consumption. But I think just given how democratized India is now becoming in terms of consumption patterns, you also have urban India that's very value-seeking. I think there's a slightly more thin line compared to what it used to be before between urban and rural. And so to that extent, there will definitely be positive effects for urban India as well.
We talk about how, if you take a look at the headline, it is market positive, but if you take a look at the possible implications as seen from the bond market, the concerns about perhaps having to sell more bonds to back spending, what are the major concerns? What are the risks that you see?
Yeah, look, I think the risks are really, linked around, for example, where will the government make up this fiscal deficit or this extra revenue loss that they will incur from? Right now, there is talks of privatization of banks that will probably be able to generate a little bit of revenue for them, the bond markets, like you said, but it's not as straightforward. I think estimates currently suggest that in the near term, their target of 5.5% to maybe, of 5%, to FY26 might get pushed to 5.3, 5.4%, and whether they're able to stick to the 4.4% FY27 is really where we need to see. I think the other risk really is that this GST basket differs state to state, as we discussed, and so what is the state level impact of some of these changes in GST, because you might have some states that depend a lot more on certain categories where rates have been cut. I think that is the other second order implication that we don't know yet.
So given the perspective that you have just shared with us, does it impact the way, does it shape the way, influence the way you look at the companies that you are looking to invest in, or perhaps, further invest in whatever you have right now?
Yeah, well, not really, simply because, our mandate has always been going after domestic private consumption. So, in fact, all of the companies that we've invested in have little to no revenues coming from outside of India. And so to that extent, purely from a portfolio perspective, this is going to be a net positive as long as consumption kicks off in the way the government and the rest of the economy is expecting it to happen. For our portfolio, it's definitely a net positive at this point.
And you don't see that much of a risk coming from that?
No.
In terms of your the timeline for preparing for an exit, what are you looking at? What are some of the considerations?
Yeah, so look, I think from our Fund 1, we're expecting our first exit to come next year. This will be a 5.5-year hold period, and so very much in sync with what we've promised to our investors, which is a 5 to 7-year hold period on any investments before we exit. Will likely be a public market exit, and I think that's the beauty that India has, or the advantage that India has today, is that even liquidity in the market is so domestic driven that the public markets are, one would argue, operating at all-time high multiples, but on the other hand are seeing enough liquidity for companies to be able to exit effectively.
Well, the question really is whether you see the risk from it being a domestically driven market.
No, I mean, for us, like I said, right, 60% of the GDP is domestic consumption. That's not going to change tomorrow, and so actually for us, this GST reform is beneficial not only to our companies but to other countries as well. Now, if the rupee were to depreciate, what are the impacts of that on exports, etc.? So I think our portfolio is insulated from that because, like I mentioned, we don't have too much of dependence on exports, or our companies don't sell outside of India. So yes, there could be an impact for companies that are highly export driven. Today the tariffs are more towards products. What happens if Trump decides to place tariffs on services in India? I think those risks always exist.
And of course, your Fund 2, you're looking to raise even more. Where are you with that?
Yes.
What are the chances that you will meet, possibly even exceed, perhaps?
Yes. Look, we've been very fortunate. Our first close target was $125 million, against which we raised $150, and so very fortunate to have received a lot of backing from our existing Fund 1 investors as well as new investors. The markets are obviously not easy, simply because DPIs have come down, especially in the US and the other developed markets, and so when DPIs come down, new allocations, they're the ones that suffer the most. Having said that, I think India as a market is now on everyone's mind, from a diversification perspective, from a size of geography perspective, from economic and political stability perspective, and so we are actually seeing a positive intent from most LPs, and we feel fairly confident that we will get to 225. Whether we exceed that or not, I think it's just a function of really where we are in 2026.
And of course, when you take a look at Southeast Asia, some of the markets here are also pretty much domestically driven.
Yes.
Indonesia, case in point. But unfortunately, we've seen, the recent developments, violent protests. Does it affect how you look at that particular market?
Yeah, so look, we've, when we originally thought of Fund 1 and we sort of thought of our sort of investing mandate, candidly, we had hoped to do 50% Southeast Asia and 50% in India. But I think, we've become overweight on India over time. Our deployment is now 70-75% India and slightly more opportunistically towards Southeast Asia. And the main reasons for that is, I think the exit landscape here has been not as strong as it has been either on the M&A or on the public market side. There's no one single market here, and so from a regulations perspective, if you're building a consumer business, you have to really build individual businesses across different countries from a regulations perspective, a consumption and a consumer mindset perspective, and then each of these geographies is seeing their own sort of political challenges with corruption becoming upfront and center in Indonesia and the Philippines. And so today, while we've got two very large investments in the Philippines, it so happens that that's the only market that we've invested in, and we haven't really dipped our feet into Indonesia yet.
Okay, Rishika, thank you so much for your perspective today. Thanks for joining us.
My pleasure. Thank
Rishika
you.
Chandan, Managing Partner at Venturi Partners. Now, before we go, here's a look at our show for tomorrow. We'll keep the focus on emerging market stocks with Morgan Stanley's Amy Oldenburg. Plus, we'll discuss growth opportunities in India's chips industry. Keep it here with us. This is Bloomberg.